I am live right now. I will be taking your requests and your questions in this live stream. But first, we need to understand what's going on in the mortgage market right now. Because you guys might be seeing the news. Mortgage rates plunged yesterday. They went from 4.18%, the 30-year fixed mortgage, all the way to 3.9%. And this had to do with Russia's invasion of Ukraine and the stiff sanctions that were put on Russia because of that. That basically freaked out a lot of institutional banks and bond buyers, and that caused treasury yields to decline, mortgage rates to decline. But what we're seeing now is that in the last day, mortgage rates have bounced back. Now they're back up above 4%, and we're likely to see that bounce back continue over the next couple days, as Jerome Powell just testified. Even with the Russian invasion of Ukraine, we are going to see the Fed increase interest rates in 2 weeks. And they're going to start quantitative tightening pretty soon thereafter. So rates are going up, and with the higher inflation that we are seeing, of course, from this invasion, higher gas prices, oil's now up to $105 a barrel. That higher inflation is going to continue to push interest rates up, and it's going to continue to push this mortgage rate up over the next several weeks, over the next several months, and that's going to cause big problems in the U.S. housing market going forward, as I'm going to talk about in this video. And we're going to talk about different cities across America and their exposure to higher interest rates and higher mortgage rates, and just how expensive it's getting for you as a home buyer right now in 2022. We're going to take a look in this video at just how much you're going to be paying if you buy a home today in terms of your ongoing mortgage costs and in terms of your ongoing property taxes. And we're going to take a look at how that compares in different cities over time, actually over the last 25 years. So you can get some real context for just how expensive or affordable your local housing market is today. And this is going to be a key insight that's going to let you know whether now is the right time for you to buy or whether you should wait for the inevitable crash that's going to bring prices down, that's going to bring mortgage payments down. Because as we're about to see in just 1 second, there's big differences that exist across all of America in terms of, number one, how big the housing bubbles are, number two, how priced out locals are, and then number three, how exposed these cities and markets are to these future increased mortgage rates and interest rates. And even if they don't go up any further from where they are right now, we're going to see in a second, certain cities are just in major trouble in terms of affordability. They look a lot like they did back in 2006, 2007. So I'm going to start off showing you some cities that I already have pre-planned here, and then I'm going to take your requests. I'm going to take your questions. This is live, so stick around over the next 5 to 10 minutes, and I'm going to start taking your requests after that, folks. So let's get into it. This is a really exciting topic. I'm also going to be revealing a new data point that I actually invented here at ReVenture Consulting, a new data point, a new indicator that's going to tell you whether your housing market's in a big bubble or not. So let's get into it, everyone. So we were just looking at this graph on mortgage rates to reaffirm. We were at 4.2% below before the Russia invasion. We dropped down to 3.9. Now we're back up above 4%. We're going to continue going up over the next couple days, over the next couple weeks. But really what you need to ask yourself is what's going on in my city in terms of the mortgage rate's impact on how much I'm paying. And you can see there's big differences across America in terms of how expensive your housing market, your city is. And knowing how expensive it is for you to buy a home is obviously important for you on a budgetary standpoint, knowing how much money you have available to spend on your home ownership costs. But you also need to know that in terms of the risk of your market having a big housing crash. And I'm not going to sugarcoat it, folks. The markets in red here are all at a big risk, because what we're looking at is the total payments, the total costs that you need to pay as a home buyer. And just let's take, for instance, Salt Lake City. We can see here that the total cost of home ownership in a year in Salt Lake City, based off mortgage payments and property taxes, are $34,000. So if you're a home buyer in Salt Lake City, buying the typical home, expect to pay $34,000, probably a bit more when you tack on insurance and maintenance. The typical wage, though, in Salt Lake City, and this is where it gets crazy, folks, is $56,000. So that means that the typical worker in Salt Lake needs to pay 61% of their wages to home ownership costs. At the other end of the spectrum, we have a place like Pittsburgh, Completely different situation. In Pittsburgh, the total ownership cost for a home buyer, mortgage payments and property taxes, is only $14,000. Is only $14,000, so less than half of Salt Lake, and the earnings are $49,000. So the typical worker in Pittsburgh is only paying 29% of their wages to home ownership costs compared to 61% in Salt Lake City. And we're going to take a look at all these different markets on this map in today's video, everyone, and you can already see someone in Pittsburgh is less scared of mortgage rates hikes impacting their decision to buy than someone in Salt Lake City, because there's a lot more room to absorb these increases. And let me just show you what I'm talking about more with some historical context. And now we're actually looking at Seattle, Washington. This is Seattle, Washington. The annual cost for a new home buyer over the last 25 years in Seattle. And what do you see? Well, jumps off the page right now through early 2022. And you really need to pay attention to this, everyone, because this is the devil in the details of the U.S. housing market right here in Seattle. The typical cost for a home buyer today in Seattle will be nearly $50,000 in a year between mortgage payments and property taxes, right around $47,000. The long-term average, pay attention to this yellow line, the long-term average is $24,000 in Seattle over the last 25 years. So we are double the long-term average right now in Seattle in terms of how much a home buyer needs to pay for the ongoing costs of home ownership. And you can see this is going to be a big problem because we are now well above the peak that occurred in 2007 in Seattle in terms of how much people were paying. And this wasn't a sustainable amount of money for people in Seattle to pay back then. And there was a big crash in home prices, nearly 35% in Seattle in the last housing crash. Why? We got up to this level where locals couldn't afford the homes. That's what this means, everyone. If you're a home buyer and we get to this peak, we're even a bigger peak today in Seattle. Locals can't afford the homes. And we're going to look at even more cities in just a second, but it's just really important for you to understand this. I want you to start thinking about the housing market in 2022, not in terms of where people want to live or where people want to buy. That was the way that you could have thought of the housing market, say 5 years ago. When Seattle 5 years ago was cheap. In 2016, it was only $25,000 per year to own a home. Now it's $47,000. So we need to start thinking about Seattle and markets like Seattle, say a place like Austin, Texas, which I'm going to pull up right here, everyone. Austin, Texas. Look at this, everyone. In Austin, Texas, the long-term average for homeowners and new home buyers is paying $19,000 a year in home ownership costs. Now we're up to $41,000 between mortgage payments and property taxes, which you can see outlined on the tooltip right there. And so what I want you to think about is that, yes, in 2016 and 2017, it was very much where do people want to live that influenced the U.S. housing market. But going forward in this rising interest and mortgage rate environment, which make no mistake, everyone, don't believe the headlines of the last day or two about the mortgage rate plunge. Yes, it happened. It was a blip on the radar. They're already going back up. They're going to continue to go back up. So now with higher mortgage rates and that cost for you as a home buyer just surging like that, the question is not going to be, where do people want to move? It's going to be, where can they afford to move? Where can they afford to buy a home? That's going to be the big question going forward in the U.S. housing market in 2022, 2023. And that affordability piece is going to determine whether your city has a big housing crash or whether it doesn't really have a crash and it's supported. Let's take a look at another city now to prove my point. Let's look at New York, because we're going to see a bit of a different situation in the New York metro area, which is what we are looking at right now in terms of home ownership costs. And let me just pull my graph back up. So now we're looking again, home ownership costs. You as a home buyer, if you're in the New York metro, and that includes Long Island, that includes Northern Jersey, that includes Westchester, even some parts of Pennsylvania, as well as New York City. Right now, on average, across that very large metro area, you're paying $42,000 a year if you're a new home buyer, which is crazy because that's the same amount as Austin, Texas. Austin is now as expensive as New York, which is nuts. You can see that that's actually less than you were paying, though, in 06, 07. So this is an interesting situation. We just saw how Austin was a city where there's a massive surge in homeownership costs above anything that's ever occurred before in this metro area, which means if you're buying in Austin today, you're paying a price on the acquisition in terms of costs that no one in Austin's ever paid before. But if you're buying in New York today, you potentially feel a little better because prices are up, but they're still below where they were in 06-07, especially when you look at it relative to how much money people make, which is what this graph looks at. We're taking the home ownership cost and we're comparing it to the earnings, how much money the typical worker makes. And you can see, yes, New York is still very expensive today. 66% of a worker's wages would need to go to home ownership costs. That is expensive. I'm not trying to say New York isn't expensive, but I'm saying it's actually less expensive than it was in 06-07, in the previous bubble, when that cost ratio was like 94%, like it was absurd in 06-07, how much people in New York had to pay for that home ownership cost. And now we're at 66% in New York. So we're still expensive, but you can see we're not in nearly as big of a bubble in terms of New York home prices and mortgage payments and cost and affordability as we were back then. And I think it's really interesting. Let's compare New York, the blue line, to San Francisco, the green line. So San Francisco's the green line here. New York's the blue line. And what do we see? We see that back in 06-07, both of these markets, New York and San Francisco, were in big bubbles. Prices and mortgage payments were at levels that no one could afford. And when that's the case, you're going to have a housing crash, everyone. You can't have mortgage payments at 100% of wages and expect that to continue. Both metros did have a housing crash, San Francisco and New York, but then behaved very differently since then. San Francisco is now back to its previous bubble levels in terms of pricing locals out. Amazingly, the annual cost of home ownership in the San Francisco Bay Area, which includes Oakland, which includes Marin County, which includes Contra Costa County, and of course San Francisco, is $86,000 a year. Unbelievable. The typical worker makes $79,000 a year. So the typical worker makes less than the typical cost of home ownership in San Francisco. That's not going to sustain itself. But we can see New York, it's actually in a better situation than before. And so this is really important to remember, everyone. To determine how big a bubble your housing market is and how much it's going to crash, you need to be paying attention to this mortgage payment and annual cost data for you as a home buyer, how much you are going to pay in ongoing costs, and how that compares to local wages, which is a reflection of economic prosperity and inflation, and how that compares over time. Because that is what tells you whether your housing market is in a bubble or not. And as I just showed you, San Francisco is still in a big bubble. New York might be in a bit of a bubble, but not like it was before. Now, let's go back to this map, everyone. And again, the areas in red have higher home ownership costs relative to earnings. The areas in blue have lower home ownership costs relative to earnings. And I want you to think about, as mortgage rates go up, as inflation goes up, and people all of a sudden have less money to spend, and less money to spend in terms of their home payment, what areas of the country do you think are going to be the most protected and able to absorb these higher costs from inflation and mortgage payments? It's going to be the areas in blue, where locals can still afford homes. Like, take a look at Milwaukee, Wisconsin. The local home buyer there is spending 33% of their wages on home ownership costs, which is below average. The U.S. average is about 35%. How about a place like Detroit? The local home buyer is spending 29% of their wages on home ownership costs. In Chicago, it's 38%, a little above average. In St. Louis, it's 26%. In Birmingham, Alabama, it's 26% as well. In New Orleans, it's 30%. So these areas in blue, I want you to think maybe they're not the most desirable places to live And maybe not a lot of people have wanted to move there. But really, in terms of the question going forward, can people afford to buy the homes? The answer is yes in the places in blue. It is no in the places in red. We talked about Austin, Texas, where the local home buyer is now spending 71% of their earnings on their homeownership costs. We talked about Salt Lake City. What about Reno, Nevada, where it's 70%? What about LA, where the local buyer is spending 86% of their earnings on homeownership costs? What about Missoula, Montana, where they're spending 84%? What about, I can't pronounce that, Wenatchee, Washington, they're spending 77%. These areas in red are tremendously at risk in this inflationary and mortgage rate environment. Because as the mortgage rates go up further, we can already see like most of these areas are already priced out for locals. And you're already saying to yourself, how are these local housing markets sustaining themselves when a worker needs to spend 70% of their earnings on home ownership? If we increase mortgage rates more, which we will, the Fed is going to jack up rates throughout 2022. They're going to sell their mortgage-backed security portfolio likely as well, which is going to further push up rates. This is going to be a big problem for those areas in red. And folks, I'm going a little long right now. I'm going to get to your requests in just 1 second, but stick with me for another couple minutes. But it's so important that you understand this, that those areas in red, when you hear someone say inflation, like, oh, inflation is good for the housing market, so many people say that, and it is maybe true for the areas in blue. Because if we do have more inflation, these areas in blue, they're affordable enough that their housing markets can grow with inflation and absorb the higher mortgage rates. These areas in red, like a Denver, it's not going to happen that way. Because as inflation continues to erode savings and down payment ability, and as the mortgage rates continue going up, it's just going to make these markets in red, which are already so unaffordable, even more unaffordable. And that's going to crash them down. And we're already starting to see that with big declines in mortgage applications. We had a massive 15% week-over-week decline in mortgage applications last week. They went down again this week. We're just going to see these markets in red really struggle. So remember, if someone says to you, inflation is good for the housing market, I want you to think back, what does inflation actually do to home buyers? It lowers their savings, and then it creates higher interest rates, which lowers their ability to afford homes. That is assuredly not going to be good for the areas in red on this map. It's going to be potentially better for the areas in blue. All right, folks, so I think I've gone on long enough on this topic. So let's get to some of your requests, everyone, and also questions. If you have any questions you want me to answer as well, I will be happy to answer that. Mike Hawk, you said this is identical to 2007. You are right. It's crazy how the same places in 2007 that were overvalued. I mean, take a look at this, everyone. We're going to let's go to Phoenix. Phoenix is a great one to look at. All right. Phoenix is a perfect example. Look at this rise from 04 to 06 in the cost for home buyers, the ongoing mortgage and property tax costs in Phoenix. Clearly not sustainable. You can't jack up mortgage payments and ownership costs that fast. Well, we had a crash in Phoenix. Where are we at now in Phoenix? Wow. We are back to the same place we were before. So, we can see the long-term average in Phoenix is $14,000 for a home buyer. We're at $26,000. This is going to go towards the long-term average. It might not crash back down to $14,000. I doubt you're going to get a home in Phoenix in a year or two and pay $14,000 in annual costs. But you can see very clearly that this is not going to sustain itself. This is going to go back down. Someone just requested Vegas. Let's get Vegas, because that's also another kind of boom market last time around. And we can see very similar situation. Our mortgage cost, what you pay as a home buyer, is stable, and then wham, it doubled in It doubled in 3 years, from $14,000 to $28,000 in 06. Boom, massive crash. Then it went all the way down to $7,000. Now we're back up to $24,000 when the long-term average is $15,000. So if you're looking at buying a home in Vegas and you look at this graph, you have to say to yourself, wow, I'm buying at a historically expensive time in Vegas's housing market over the last 25 years. It's very likely that this mortgage payment goes down, and that means prices are going to go down. We got a lot of requests for Houston, so let's take a look at Houston, everyone. I was actually just in Houston 2 days ago. Very nice city. I actually like Houston a lot. I know a lot of people don't like the humidity and the hurricanes, but I think it has a lot of charm. So this is the long-term average of home ownership costs in Houston. We can see a lot more stability than Vegas. Like take a look at Vegas one more time. We see Vegas is like super up and down, right? We can see Houston is much more stable historically, where from like 96 all the way to like 2016, your cost as a home buyer didn't change. Now they've gone up since then. So, I think Houston, it's in a bit of a bubble. I think Houston's going to have a correction because we could see this long-term average is 13,000 and we're at 20,000. So this is going to go down, but let's also take a look in relation to how much locals earn. So you can see here the long-term average is a home buyer spending 28% of their earnings in Houston on their homeownership costs. Now it's up to 37, so we're high. We're high in Houston. It's going to come down a bit, but we're not in like this like massive crash scenario in Houston like we are in other places. Let's see here. Portland, Oregon. This is actually a really interesting one, everyone. Portland, Oregon. You can see volatility in Portland, a lot more volatility in Portland than Houston. And if we take a look at the payments, because I know you guys care about the payments, the typical home buyer in Portland today paying $30,000 a year in mortgage payments, $5,000 a year in property taxes. That's $35,000 total. That compares to $27,000 at the peak of the previous bubble. I think there was like a 20 to 25% decline in Portland's housing market, 07. To 2012, and the payment level went down to $14,000. Now we're back up to $35,000 when the long-term average is $19,000. So we know this is not sustainable. We have 25 years of housing market data in Portland saying that it averages about $20,000 a year for a new home buyer in terms of their cost. We're up to $35,000. Of course, we should adjust for wages. And we can see that adjusting for wages, a typical home buyer in Portland spending 60% of their earnings on home ownership. It's too high. It's not going to stay that high. It's going to go down. And since mortgage rates are going to be going up, it's not going to be going down through lower mortgage rates. It's going to go down through a declining home price in Portland. And one thing I want to just real quick, I'm going to get to more of your requests in a second, but back to that inflation piece. The only way that inflation would be a positive for home values is if it increases wages. So I want you to think of that. When people say inflation is good for the housing market, what they really mean is inflation is going to increase wages and income, which will allow people to afford more on rent and home prices and mortgage payments. That is the only way inflation can be good for the housing market and push home prices up. If home prices and rents go up faster than wages, that's not a sustainable situation. And that's what we're seeing right now. And that's what this, in Portland, this annual homeownership cost of earnings is showing. It's saying that we're at 60%. And since it's going up, it means that the cost of homeownership is going up more than inflation. And let me show you another city here. A personal favorite of mine, everyone, is Boise, Idaho. Boise, Idaho, and yeah, strap in here, folks, for this one, because this is the biggest bubble in America. 37% is that long-term average in terms of what a home buyer in Boise spends of their earnings. Now, we can see it was 54% in 07, peak of the last bubble. It crashed to 24%. Boise home prices went down by about 35%. So it got cheaper for you as a home buyer. Now Boise's up to 66% of local wages needed to afford a home. So inflation very clearly is going to be bad for Boise's housing market because it's going to mean that the local home buyer who's already stretched is going to have less money for their savings and down payment. And then the higher interest and mortgage rates are just going to mess this market up even more in terms of affordability, and people are going to move out, less people are going to move there. Boise is a ticking time bomb. It's already the worst performing housing market in America over the last 6 months. It's going to crash hard in 2022 in Boise. Let me take a look at some more requests, everyone. We got San Antonio, Texas, and let's do a little comparison here. We got a request for San Antonio, and I want to compare San Antonio, and I got all these cities here, folks, so I'm going to show you your housing market in a second, so stick with me. We got all these housing markets here. But we're going to compare San Antonio to Austin, because this is a very interesting comparison. These two metros are an hour drive from each other. And you can see historically that, yes, Austin is more expensive for local home buyers by about like 5% or so in terms of how much a home buyer pays. But then, bam, Austin's now up to 71% over the last literally 18 months. Crazy. San Antonio's only up to 47%. And so while I think both these markets are in bubbles, Austin's in a very large bubble that you can tell from this graph. San Antonio, not nearly as much. Like San Antonio at 47%, we're not that far off from the historical norm in terms of how much a home buyer pays for their ongoing mortgage costs and property taxes in San Antonio. So I think both markets are in bubbles, but San Antonio is going to have a much less of a dip in home prices over the next couple years because locals can still afford the homes. So that's a really important thing to understand. These two markets, these two cities are just an hour from each other, yet they're showing very different relative value compositions here in terms of how much affordability there is. So let's see here. What do we got next? I saw a request for DC. Let's look at DC, everyone, and let's go back to looking at the total payments. And we're still on Boise here, so let me just change it to DC. All right, Washington, D.C. All right. So home buyer in the D.C. metro today, which includes Northern Virginia, that includes Fairfax County, that includes Arlington. This also includes Bethesda, Maryland. All of that's in the D.C. metro area. Is paying $34,000 on average, $29,000 for mortgage payments, $5,000 from taxes. That is up a lot over the last year, but it's actually less than in the bubble in 06. So DC is another scenario kind of like New York, where yes, it's expensive, objectively expensive, but in terms of relative cost over time, we can actually see that DC's gotten cheaper. Look at this, folks. A home buyer in DC is paying 49% of their earnings to ownership costs today. That was 75% in the previous bubble in 07. So very clear that DC was in a big bubble in 07. It wasn't sustainable. And then bam, we had a big crash. And then actually since like 2010, DC's been pretty stable in terms of how much a local home buyer needs to pay to own a home. I don't foresee a big crash in the Washington, D.C. metro because of that. Let's take a look actually at a Midwest metro actually, folks. Pittsburgh. I want a couple Midwest metros. I'm going to get to your requests in the Sun Belt in a second. But I just want you folks to understand this. Like Pittsburgh. Why Pittsburgh is a place that's not going to crash. And you can see very clearly why it's a place that's not going to crash. The costs of home ownership stay very stable over time. We're around 24% over the last 15 years of worker wages going to home ownership costs. Yes, we're up a bit in the last year. Maybe Pittsburgh has a slight correction, but it's not going to have a crash because it is still relatively affordable for someone to buy a home in Pittsburgh. And let's just go back to this comparison chart, and let's put Pittsburgh on here. And I'm going to compare Pittsburgh to, let's compare Pittsburgh actually to Cape Coral, Fort Myers. This will be an interesting comparison, everyone, because you're going to see basically a housing market in Pittsburgh that's very stable, and then one in Cape Coral that's all over the place. So just bear with me for 1 second. All right, look at this, everyone. Isn't this amazing? How different cities in the U.S. housing market are. I mean, this just gets me excited when I look at a graph like this. You got to get excited. Pittsburgh, this turquoise line, very stable in terms of home ownership costs. Cape Coral, geez, back in 07, 80%, and then went all the way down basically to the level of Pittsburgh, and now we're up to 53%. So Cape Coral, Fort Myers, not in as big a bubble as it was in 07, right? Clearly not, but in a bubble. A local buyer has to pay more than half of their earnings. Compare that to Pittsburgh, where they're only paying 29% of their earnings. Let's throw Tucson on this graph for an additional point of comparison, because I see someone, Luis wants to hear about Tucson, so let's do that. And you can see Tucson's kind of like in between both Cape Coral in Pittsburgh. We can see a buyer in Tucson is paying 44% of their earnings to home ownership costs. That was 60% back in 07. So again, Tucson, a bit of a bubble today, not as bad as it was back in 2007. Pittsburgh, kind of the picture of stability. And I'm going to get to a couple more of your requests in a second, but again, I want to reaffirm this point to you. Some people might watch this video and say, oh, well, the reason that it's still relatively affordable in DC and Pittsburgh or a place like Chicago or Milwaukee is because no one wants to live there. And that is a fair point to make. The Midwest is not a place that attracts a lot of growth, Northeast as well. But again, we're now at a point in the housing cycle where prices are so expensive and mortgage rates are going up so fast and inflation is going up so fast that it's no longer a question of where do people want to live. That's out the window going forward. It's where can they afford to live? Where can they afford to buy? That's what you really need to ask yourself. And again, it's the places in blue on this map where they can do that. So if you're someone searching for a city where you can afford a home and you want to buy a home and not have the value go down by that much, it's going to be in these areas in blue. A place like Cincinnati would meet the criteria. A place like Indianapolis would meet the criteria. 29% home ownership cost. That's not bad. That's below average, meaning it's still affordable there. What if we were to go into Peoria, Illinois? 20%. What if we were to go to Des Moines, Iowa? 32%. My personal favorite, Oklahoma City. You're only paying 28% of your earnings for home ownership cost in Oklahoma City. So 28% in Oklahoma City, 71% in Austin. 28% in Oklahoma City, 71% in Austin. It's obvious which market's going to crash and where's the better place to buy. And actually, I lived in Austin and I spent a lot of time in Oklahoma City, and I can tell you that the relative value that you get from living in these places is much better in Oklahoma City. So we're going to see a reversal over the next 5 years in migration trends. We're going to see a lot more people move to these areas in blue than we did before. Like, interestingly, a place like Greensboro, North Carolina is affordable. And I actually kind of like a market like this because it is in a bubble. Don't get me wrong. Greensboro is kind of crazy right now. But when your home ownership cost is 27% in Greensboro, compared to 47% in Raleigh, you begin to see kind of the relative value difference. 45 to 47% in Raleigh, 27% in Greensboro, 26% in Winston-Salem. So, you have remote work, right? People kind of thought that remote work was solely to the benefit of a place like Raleigh. But wait a minute. Someone who's in Raleigh who feels priced out of that housing market can now move to Greensboro, right? So I want you folks to think about this, that a lot of the tertiary markets that are still affordable, I think are pretty good places to buy right now if you want stability. That doesn't mean they won't go down, but it's unlikely that they're going to suffer a big crash. All right, everyone. We got to talk a little bit about Florida too, because I know a lot of you care about Florida. Port St. Lucie is a market I know a lot of you are in. 52% home ownership costs in Port St. Lucie, 50% in Miami. So we can see we're expensive. We're definitely expensive in Southeast Florida. But what's interesting is this. If we go to Miami, check this out, folks. Check this out. If we go to Miami, yes, we're at 50%. A home buyer is paying 50% in the Miami metro area, which includes Fort Lauderdale and West Palm Beach, of their wages for home ownership. That's compared to 72% in 07. Miami had a big crash. So Miami is much cheaper today for a home buyer than it was in 07. So it's one of the reasons I'm actually kind of bullish on Miami, because it might be in kind of a little bit of a bubble, but it's not at all close to what it was in 07. And we have so many cities in America that are more expensive than they were back then. A place like Miami is cheaper than it was back then. So I think a place like that is going to be much more secure. All right, everyone, I'm going to take some more of your requests. Where do you want to see right now? Someone just requested Raleigh. Let's just do Raleigh real quick, even though I just covered it. So, Raleigh, North Carolina. 47% of wages go into home ownership costs compared to 49% in previous bubble. So, Raleigh is in a bit of a bubble. Home prices, I think, went down by 10 to 15% in the last crash. Wouldn't be surprised if we see a similar correction given how expensive it has gotten in Raleigh. What about a place like Charlotte? looks almost identical to Raleigh. We're basically approaching the '07 bubble levels in Charlotte in terms of how expensive it is. So if you're a home buyer in Charlotte, $21,000 annual cost compared to $56,000 wages, 38%. That's actually not that expensive overall, but we're approaching '07 levels. So that's that's a situation where I think there's a bit of a bubble in Charlotte. Probably not going to be a major crash. However, in Provo, Utah, which someone just requested, check this out, everyone. Check out Provo, Utah. Woo! 70%. The average worker in Provo earns $46,000. Yet this is one of the most expensive housing markets in America. It's one of the reasons why I think Utah is in one of the biggest housing bubbles in America. Because when you look at the fundamental data, nothing makes sense about the current home prices. Locals in Provo went from spending 43% of their wages on home ownership to 70% in 18 months. Not sustainable. Don't care about inflation. Doesn't matter. This is not sustainable. And we can see where you're at 86% in the last bubble. Provo had a pretty big crash. It's going to have another one going forward in Provo. What's another market that's like this? Denver. Let's check out Denver. A place where, if you saw my post today, violent crime is going way up in Denver. I'm going to have more data on crime for you folks coming soon. But you can see Denver is a place we're getting concerned, because Denver is more expensive than it has ever been compared to wages. 58% of your wages, of the 61,000 average worker wages, are going to the 36,000 home ownership cost. That compares to the 42% long-term average. So again, the more we go up above this yellow line, the more we're in a bubble, and the more likely we are to trend down to this yellow line eventually. Now, let's do a comparison. Let's compare Denver. What you got here? Hold on, folks. Let's compare Denver. So I got a bunch of lines on this graph. Bear with me for 1 second, everyone. We got Denver, and we're going to compare it to El Paso, Texas. And you folks might be saying, why would you compare Denver to El Paso, Texas? Well, I'm going to show you in 1 second why you would want to do that. All right. So in El Paso, Denver, you could see compared to earnings, these markets were pretty similar in the last bubble, had a pretty similar decline. And these markets are so different from each other. Denver is like 3 times as expensive, but we're adjusting for that by looking at the wages here. But then, big difference. Denver has now surged to 60% home ownership cost. El Paso's at 41%. So what this means is a home buyer in El Paso, a local home buyer who only earns $34,000 a year, well, the mortgage payment and property taxes are about $14,000 in El Paso. So they can still afford the home. It's starting to get expensive. But we can see that there's a lot more fundamental support in El Paso than there is in Denver. And that's just really important for you all to understand, is that when you think of the local housing market, higher mortgage rates and inflation, look at wages. Because everything comes down to wages and income. You can only price out locals for so long. At some point, the migration deluge of rich cash buyers is going to subside. It will. It always does. And when it does, and then the local is forced to support the current home prices and mortgage payments, that's when you end up with problems in the places in red. Now, what about a place like Tampa? I can see a lot of you requesting info on Tampa, so let's look at it. Typical ownership costs of $21,000 compared to $50,000 earnings. And we can see we're kind of like a translucent color here in Tampa. So what does that mean? 41%. Well, it's not that expensive in Tampa, but how does it compare to history? Let's see that, because that's really what matters. Well, we can see a $21,000 home ownership cost, which comes from $18,000 mortgage payments, $3,000 property taxes. We're now above where we were in '06. So this is a little concerning, right? It's like we had this big run up to '06, then we had a big crash. We kind of stabilized, and now we had a big run up again. And so the long-term average in Tampa is $11,000. So a home buyer in Tampa would pay $11,000 on average over the long run. And we're way above that today. So yes, there's significant downside in Tampa's housing market. We're probably not going to get back to this level, but don't be surprised if we see like a 20% correction in Tampa over the next couple of years. It's going to take a while to happen. I would not expect that overnight, but you can see clearly from this graph that this is not a situation that's going to persist in terms of locals being priced out. As soon as the trickle of New York transplants slows, it's going to be a big problem. Now, I had someone request that we compare Houston to Dallas to Austin versus San Antonio. And that sounds like a lot of fun. So let's do that. That's my idea of fun. Let's compare Houston to Austin to Dallas to San Antonio in terms of how expensive these housing markets are. Because for me, this is actually something I'm considering. I lived in Austin, and now we have all these graphs, lines on at once, which is not good. Let's get only the ones we want. So I lived in Austin, said that I didn't like Austin, and now I'm in Dallas. And I actually just checked out Houston the other day, and I actually kind of like Houston. I like the idea that the home ownership costs are cheaper there. I like the people in that city. But how do all of these cities compare to each other in Texas? Because I know a lot of you are looking in Texas, right? And so, all right, let's do a little refresh here on the coloring so you folks can see this really clearly. Because I want you to see this clearly. Take a look at this, everyone. All right. Home ownership cost percentage in Austin in blue compared to San Antonio in turquoise, compared to Dallas in orange, compared to Houston in red. Which one's in the bubble, everyone? I'll give you one guess looking at this. Which one's in the biggest bubble? Very obvious. Austin, Texas is in the biggest bubble in a way that no other city in Texas is. But, you know, they're all in kind of a little bubble in and of themselves. San Antonio, 47% compared to 39% in the previous bubble. We're going to see a correction. Dallas is at 40% compared to 33% in the previous bubble. We're going to see a correction. Houston's at 38% compared to 30%. So we're going to see correction in all these cities, but we're going to see a big crash in Austin. Austin bubble, that's right. A lot of you saying are Austin bubble. So you can see very clearly that there's an Austin bubble. And so, folks, get some of your last requests ready. I'm about ready to sign off. We covered a lot of different cities. In case I didn't cover yours, I apologize. If I don't cover it in the next couple minutes, what I want you to do is leave a comment, not in the live chat, but in the comment section of the video. And I can do my best to respond to that comment after this video post. So if I don't get to your city in the next couple minutes, do that. But signing off here, right? A lot of people are trying to spin a narrative that we're not in a housing bubble, there's not going to be a housing crash. That is absolute crap. There is no fundamental data point which supports today's housing market. If you look at jobs, if you look at wages, if you look at population growth, even if you look at inflation, nothing supports what's happened to home prices and rents in America over the last 12 to 18 months. And when nothing fundamental supports the prevailing values, you know it's a bubble. Every time in U.S. history that this has happened, that home prices have gone way above fundamentals, whether it's national or local, there's typically a housing crash. So get ready for that, be prepared. I'm sure all of you know this intuitively. You try to go and buy a home right now, and it makes no sense. There's no homes on the market. A 1,000 square foot piece of crap is going for $700,000 in Austin, Texas. Like, it doesn't make any sense. And the only people who believe that the bubble is going to keep going on are realtors and real estate investors, people who have a financial interest in seeing it occur. But as I showed you in this video, when we look very clearly about what you as a home buyer need to pay in these markets to own, it makes no sense. No matter what argument you try to spin regarding inflation or the supposed housing shortage, it makes no sense and values are coming down. So just understand that the Federal Reserve is tightening monetary policy, interest rates are going up, quantitative tightening, we're selling the mortgage-backed security portfolio potentially that the Fed has, going to further increase mortgage rates. The party's over. Tenants aren't paying their rent. Lease defaults are surging. There's an eviction backlog. We have a record number of homes under construction. The list goes on in terms of why this is a massive housing bubble and we're going to have a crash. So I just want to leave it with that. Don't let anyone fool you. There's no fundamentals supporting this. I showed you that in this video. It's Russia-Ukraine thing in terms of interest and mortgage rates. That was a 2-day blip. The rates are already going back up. All right, everyone. So I'm going to take your last couple requests. So let's get into it. let's get into your last couple requests here. What do we got? Wilmington, North Carolina. All right, so let's take a look at this map. And I know a bunch of people actually that are looking at moving to Wilmington. And we can see in Wilmington that you'll be paying about $22,000 to own the typical home over the course of the year. The average local in Wilmington earns $47,000. So that's 45%. That's kind of above average, but not too high above average. And if we look historically in Wilmington, and I have time for 2 more requests after this, folks, so get them ready. What do we look at historically? So we're up to 21,000 in Wilmington today. You can see we did have a bubble last time in 07 in Wilmington. Came crashing down, but we're not in as bad a situation today. As you take a look at the cost to earnings ratio of 45%, that's actually pretty close to the long-term average of 41%. So a home buyer in Wilmington today is paying a fairly similar amount in terms of ongoing ownership cost to what they have over the last decade. It was at 66% in the last bubble. So Wilmington, potentially a correction. I don't think a big crash. Let's see, what else do we got, folks? Someone's requesting Salt Lake City. I already covered that earlier in the video. A lot of your requests, folks, I covered earlier in the video. So if you don't see your city covered, watch this video again, because I've covered about 25 different cities. Now we got an Atlanta request. Woo, woo. All right, 40% of local wages in Atlanta are going to home ownership costs. This is well above the long-term average of 27%, and we can see pretty close to what it was at the peak of the last bubble in 07. Atlanta is a market that literally, in late 2020, I would have thought, was fairly valued, 27%. Now it's up to 40%, which means we're going to have a decline closer to this dotted line. And as I showed you all in my video 2 days ago, Atlanta is the haven for investor speculation in the housing market, specifically in certain neighborhoods. If you all haven't watched that video yet, you should, on basically investors owning 20 million homes about to sell them. Atlanta is a market that is super speculative, and over the last 18 months it's gone crazy. So I think we're going to have value declines in Atlanta, mostly though in some of the regions where investors are buying. All right, what else we got here, folks? Someone requested Seattle. I already covered Seattle earlier in the video. Let's see. What's a good one to end on? How about Knoxville, Tennessee? We're going to end on Knoxville, Tennessee, everyone. This is, again, a market that looks kind of similar to Atlanta a little bit. We're up to 32% home ownership cost in Knoxville, up from 24% long-term average. So we're in a bit of a bubble. I don't think it's a big one in Knoxville. We'll probably see a bit of a correction. We'll probably see these home ownership costs in Knoxville, which are at $16,000 today. You can see the highest it's ever been. So that's a bit of a concern, right? We're higher than we were in the previous peak in 07, but I don't think it's going to be a massive crash. I know there is a lot of speculation going on in that market. It's a market 6 to 9 months ago I loved. Now it's gotten a little wild. I don't know. Maybe people watched my video 6 to 9 months ago and bought in Knoxville. But I think today it's a market you got to be careful. Don't buy in the wrong location, but I wouldn't expect a massive crash in Knoxville. And what the hell? Why not do one more? Nashville. Since we're in Tennessee, let's stick in Tennessee and look at Nashville. Some people call Nashville Nash Vegas because it's the bachelorette capital of the world. And we can see it's also the capital of a big increase in home ownership costs. You're going to be paying $24,000 in Nashville in your ongoing costs compared to $15,000 at the peak of the previous bubble. Our long-term average is $13,000. So again, when this line, red line, is above the yellow dotted line, it says we're in uncharted territory for how expensive it is for you to buy in this city. That means we could be seeing a downturn. Nashville was a place back in late 2020 I thought was a good place to buy. Now, not so much. All right, everyone, that does it for today. So if I missed your city, do 2 things. If I missed your city and you want me to cover it, do 2 things. One is go back and watch this video after it posts, because I covered about 25 to 30 different markets. I saw a lot of requests for cities I already covered. If not, leave a comment after this video posts requesting your city. And of course, guys, if you have any questions about this data, you want to know where to get it, let me know. All of this data came from Zillow. Zillow tracks data on home values across America. I'll have a link to that in the description. And the data on wages came from the Bureau of Labor Statistics. And the data on mortgage rates in the beginning came from Mortgage News Daily. So that's it for today, everyone. I'm going to see you all with another video on Friday, so get ready for that. And until next time, this is